Let's get more on the market move today as the Dow inched closer to that 20,000 mark. How should retail investors be playing this move? We have two financial planners here. Ivory Johnson, the founder of Delancey Wealth Management, a member of the CNBC Digital Financial Advisors Council, and also with us, Mark Avallone from Potomac Wealth Advisors. Okay, and Mark, what about you? I mean, is the best advice after a move like this to have people rebalance their portfolios if they've been in the market? Is it time for people to think about getting involved if they haven't been? What do you think?
Well, for individual investors, the game is always about how much risk can you tolerate. And after a big move like this, and we've seen a huge move just since the election, and we're almost 8 years into a bull market, people really need to look at how much risk they have in their portfolio. Stocks have run up. The mistake a lot of individual investors make is when there's a correction, they can be over-allocated. They react emotionally. Emotion's never a friend to the individual investor. So now might actually be a good time to rebalance and look, take inventory about what you own.
Mark, I wonder how you treat the idea of just return expectations over the next several years. You have an individual who not only has a particular risk appetite, but you have to plug in something for what stocks and bonds in combination can deliver. And it seems like right now, after the run we've had in both stocks and bonds, maybe it's not looking that great over the next 10 years, even if we have momentum in the short term. Where do you come down on the idea of what financial markets can give individual investors?
Well, that's one of the reasons why we want to be in stocks, but be cautious with stocks, because the upside potential isn't all that great at these levels. The market's fairly or fully valued by a lot of metrics. And as I said earlier, we're almost 8 years into this run. So to expect the kind of returns we've had in the past would be unreasonable. I think you can still make money in a balanced portfolio by adding smart fixed income. Credit product looks good. We think the high yield market, which correlates more to stocks than to bonds, is less sensitive to interest rate moves. And maybe that's a way a balanced investor can get a little more comfortable with adding some fixed income. But I think you're right. I think with interest rates poised to rise and stocks at these levels, the next year or two certainly don't look as ripe as the last several years.
All right, Mark Avallone, Ivory Johnson, thanks, guys, for joining us.
Thank you.